Hello and welcome everyone. My name is Yasser, and welcome to today's session on financial reporting, where we will focus on learning outcome to uh, basically preparing company financial account, be able to prepare company financial statement. In this lecture, we will explore the comprehensive financial statements for limited companies and important skills for anyone in the field of accounting and finance. So if anyone is there, can you guys see my screen and can you hear my voice? So if there is any issue, please let me know. Okay, so recap. Uh, Before we discuss the detail of preparing company financial statement, I will just revisit some foundational concept and historical development that underpin our understanding of financial reporting. A sole trader, a sole trader is a business owned and operated by a single individual's partnership. Partnership involve two or more individuals who share ownership of a businesses. Then limited company is more complex business structure where the company is a separate legal entity from its owners. Then charities are organizations established by a charitable purpose and are regulated by specific laws. Then we discussed IAS and IFR, International Financial Reporting Standard, are issued by the International Accounting Standard Board, and we have gradually replaced IAS, which is International Accounting Standard Board. Then types of financial accounting, financial statements like SO, CISO, FP, SOCF, SOCE. All of these types we discussed yesterday. SOCI, Statement of Comprehensive Income, as known as the income statement. SOFP, Statement of Financial Positions, company referred to as the balance sheet, commonly referred to as the business balance sheet. SOFP provides a snapshot of company's financial position at a particular point in time. Then statement of cash flow. The SOCF for statement of cash flow shows the inflows and outflows of cash within a company over a specific period. Then SOCE, statement of changes in equity. SOCE outlines changes in the equity section of the balance sheet over a reporting period. Right, self-assessment, you can check your knowledge, current knowledge of limited company and financial statement up to 10, as confident as possible. 10 and 1 is not confident at all. So today's individual content, indicative content is prepare a financial reporting statement for limited companies, period and adjustments. Preparation of financial reporting statement for limited companies. We will learn about the main elements of private limited companies annual accounts, including the income statement and statement of financial positions, period and adjustments, valuation of inventory, depreciation of non-current assets, straight line method, and reducing balance methods. Identification and explanation of error not affecting the trial balance. Again, types of errors, omissions, commissions, principals, compensations, original entry and reversal understanding, and correcting these errors, including the use of suspense account, journal entries, or the correction of errors, statements of revised profit and revised statement of financial positions, extracts, how to prepare revised statements reflecting correcting errors. Applications and expansions, uh, explanation of relevant accounts. We will reinforce our understanding of key accounting principle and how they apply to preparation of financial statement. Uh, right, nature of limited companies, we discussed yesterday as well. So, if anyone is there, can anyone, any comments from anyone, if anyone is there? Okay, limited company is a fundamental characteristics of limited companies, limited liability. So providing a significant advantage over sole proprietorship and partnerships. In a limited company, the liability of the owners of a shareholder is restricted to the amount they have invested in purchasing shares. This means that if the company becomes insolvent, the maximum financial loss for shareholder is limited to their initial investment, making it a less risky investment option. So the features makes limited risky investment options. The features make limited companies more attractive for investors compared to sole traders or partnership. Limited companies can be either private or public. In these companies, ownerships and management can be separated. Shareholders who own the company elect directors to manage the business operations on their behalf. The separation allows for a potentially large number of shareholders, each uh, receiving a share of the profit in the form of dividends. Uh, the purpose of financial statement for limited companies is provide crucial information about the financial position and performance to external stakeholders such as investors, creditors, and regulators. So under the Companies Act 2006, uh, limited companies are required to publish their annual accounts. These financial statements must comply with regulatory requirements and accounting standards and are often subject to audit to ensure accuracy and transparency. So, in a sense, the concept of limited liability coupled with straight financial reporting requirements ensures that limited companies operate with greater financial security and transparency, enhancing their credibility and attractiveness to investors. Any questions so far, if anyone's there? So the accounts of limited company, the financial statement of limited companies, while similar to those of sole traders and partnerships, have distinct elements reflecting their unique structure. So these elements include the statement of financial position and the statement of profit and loss account. So financial position, statement of profit and profit and loss. Uh, the statement of profit or loss details the company's financial performance over a period, showing revenue, expenses, and profit or loss. The format is similar to that of sole traders and partnerships, with the primary differences being the inclusion of corporate specific terms such as shares, capital, and taxations. Limited companies pay tax on their profits because they are recognized as a separate legal entities, distinct from their owners. So this means the company itself is is taxed on its earnings. So on the shareholders directly. Uh, Here, if you can see the specified format for a limited company's financial statements, revenue, cost of sales, gross profits, operating expensive, distribution cost, administrative, you know, expensive. So then profit from operations like financial cost, profit before tax, tax profit for the year. Then statement of financial position, also known as the balance sheet, provides a snapshot of the company's financial condition as a specific point in time. So it lists the company's assets, liabilities, and equity. For limited companies, uh, equity includes share capital and reserves, which represent the funds invested by shareholders and the accumulated profits retained in the business. So this structures presentations ensures that stakeholders have a clear understanding of the company's profitability and financial health. Any questions so far? Uh, Statement of profit and loss. Statement of profit loss for the year ended is a performer. Performer statement of profit and loss under IFRS might, looks like uh, this XYZ limited statements of profit or loss for the year ended 31st December 2022. Revenue, cost of sales, uh, gross profit, distribution cases, administrative expenses, profit from operations, finance cost, profit before tax, tax profit for the year. So this performer demonstrate now financial performance is presented in uh, standardized format, uh, facilitating comparison across uh, different periods and with other companies. IFRS ensures that financial statements reflect issues and fair view of the company's financial performance and positions, adhering to high standards of transparency and accountability. Uh, Statement of financial position, also known as the balance sheet, is a crucial financial statement that shows the assets, liabilities, and sorry, uh, equity of business and specific date. It provides a snapshot of the company's financial health and structures. So XYZ statement of financial position as at 31st December assets where you can where we can write non-current assets, current assets, total assets. So non-current assets are long-term uh, investments or physical assets such as property, plant, and equipment that the company expects to use for more than 1 year. Current assets include items like trade receivables, amount owned by consumers, and cash or cash equivalents that are accepted to be converted into cash within 1 year. The total assets figures represents the sum of non-current and current assets, giving an overall view of within the company owns. Equity and liabilities, again, financial positions, statement of financial positions, continued. The equity and liability section of the balance statement of financial position shows how the assets are financed either through shareholders' equity or through liabilities. Equity and liabilities, under equity, we mentioned share capital, share premium, retained earnings, revolution, surplus, total equity, non-current liabilities, bank loans, current liabilities, for example, trade and other payable, tax liabilities, so total liabilities, total equity and liabilities. So equity includes items like share capitals, the money invested by shareholders, share premium, retained earnings, accumulated profits not distributed as dividend, and revaluation surplus, increase in assets values recognized in the accounts. Total equity represent the shareholders' residual interest in the companies after liabilities are deducted. Non-current liabilities are long-term financial obligations such as bank loans that are due after more than 1 year. Current liabilities are short-term obligations like trade payable, amount owed to suppliers, and tax liabilities that are due within 1 year. Sorry. So current liabilities are short-term obligation like trade payable, and tax liabilities that are due within 1 year. The total liabilities figure is the sum of non-current and current liabilities. The total equity and liabilities figure must equal the total assets figure, maintaining the balance in the statement. Any questions so far? So, conceptual framework, quantitative characteristics of usual financial information, fundamental qualitative characteristics, and enhancing qualitative characteristics. Uh, Fundamental qualitative characteristics, relevance. Financial information is relevant if it can influence the economic decision of users by helping them evaluate past, present, or future events. This includes materiality, which means that information is significant enough to affect decision making. Faithful representations, financial information must faithfully uh, faithfully represent the economic phenomena it purports to depict. This means it should be complete, neutral, and free from errors, providing a true picture of the company's financial positions and performance. Enhancing qualitative characteristics. These characteristics enhance the usefulness of information that is relevant and faithfully represented. So, comparability, timelines, verifiable, and understandability. Notes to the financial. Any questions so far, if anyone's there? Okay, so notes of the to the financial statement. The notes to the financial statements play a critical role in providing a complete and transparent view of a company financial health. So these notes are required by various international financial reporting and uh, serve to offer additional information that cannot be fully disclosed in the main financial statements. Accounting policies, one of the key elements disclosed in the notes in the accounting policies adopted by the company's directors. These policies are crucial because they ensures that the financial statement give a true and fair view of the company financial performance and positions. Companies must select accounting policies that comply with IFRS and provide the most accurate representation of their financial activities. Furthermore, one established that these policies should not be changed without a compelling reason, ensuring consistency and comparability over time. Any questions so far, if anyone is there? IAS 16 and IAS 2. IAS 16 deals with the accounting for tangible items that are used in production or supply of goods or services rented to others or used for administrative purpose and are extended uh, to be used during more than one period. Tangible items have physical substance, meaning they are tangible assets like machinery, building, and equipment. The notes will provide details on the cost, depreciation methods, and accumulated depreciation of these assets, giving a clear picture of their current value and use of full life. IAS2 inventories. IAS2 provides guidance on the accounting treatment for inventories, which includes raw material, work in progress, and finished goods. Accounting to IAS2 inventories should be measured at the lower of cost and net realizable value. This rule ensures that the inventories are not overstated, which would otherwise lead to an overstatement of the company's profit. The notes will often details the method used for valuing inventories, such as FIFO, first in, first out, or weighted average cost, along with any write down or net realizable value. Any questions so far, if anyone is there? Presentation of financial statement. The presentation of financial statement is governed by several fundamental accounting principles to ensure clarity, consistency, and reliability. So, going concerns financial statement must be prepared on a going concerns basis, which means that the company is expected to continue its operations into the foreseeable future. If this assumption is not valid, the financial statement must disclose this fact and provide the necessary adjustments. Then accrual basis financial statement should be prepared on an accrual basis, meaning the transactions are recorded when they occur, not when cash is exchanged. This principle ensures that all economic activities are reflected in the period of to which they relate, providing a more accurate picture of financial performance. Materiality and aggregation uh, means that significant items must be presented separately in the financial statements, while immaterial items can be aggregated. This principle ensures that the important information is not obscured by insignificant details. Offset items are, dissimilar, should not be offset against each other unless permitted by a specific standard. This means that assets and liabilities or income and expenses should be reported separately to provide a clear and undistorted view of the company's financial positions and performance. Consistency of presentations, the way items are presented or classified in financial statements should remain consistent from one period to the next. Changes in presentations are only allowed if a new IFRS requires a different approach, uh, or if there has been a significant change in the company's operations. This consistency helps users compare financial information across different periods, enhancing the usefulness of the financial statement. Any questions so far, if anyone is there? The IASB's conceptual framework. Uh, this framework outlines the fundamental elements of financial statements. Uh, these elements are essential for understanding the uh, structure and purpose of financial reports. Each element plays a important role in depicting the financial health and operations of an entity. Assets, liability, equity, income, expenses, contribution from owners, distribution to owners. So assets is defined as a resource controlled by the entity as a result of past revenue from which future economic benefits are expected to flow to the entity. Assets are critical because they represent the resources that a company can be generate revenue and sustain operations. Examples include cash, inventory, property, and equipment. Then next is liability. A liability is present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow of resources, embodying economic benefits. Liabilities indicate the company's financial obligations, such as loans, accounts payable, and other debts that must be settled in the future. Equity represent the residual interest in the assets of the entity after deducting all its liabilities. It reflects the ownership interest held by shareholders and can be seen as the net worth of the company's equity includes share capital, retained earning, and other reserves. Income refers to increases in economic benefits during the accounting period in the form of inflows or enhancement of assets and or decreases in liabilities that result in increase in equity other than those relating to contribution from owners. Income is crucial for assessing the company's performance, covering revenues from assets, interest income, and gain from asset disposals. Expenses are decreases in economic benefits during the accounting period in the form of outflows or uh, 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 in occurrence of liabilities. The result is decrease in equity other than those relating to distributions of owners. Expenses includes cost of goods sold, wages, rent, and depreciation. Next is contribution from owners. Contributions from owners are increases in equity resulting from transfers from owners in their capacity as owners, such as issues of share capital. These contributions provide essential funding for the business to operate and expand. Then distribution distribution to owners, decrease in equity resulting from transfers to owners in their capacity as owners. For example, dividends. Any questions so far, if anyone's there? Okay, so International Standard Board Conceptual Framework. Next one, the elements and accounting equation. As everyone knows, accounting equation, assets is equal to equity plus liabilities. So what is equity? It's a contribution from owners plus income minus expense minus distributions to owners. So equation must always balance, reflecting that a company's resources, assets are financed by either debts, liabilities, or the owner's contributions. Recognition of elements for an items to be recognized in financial statements, it must meet the definition of an element, for example, assets or liability, and satisfy two criteria. First is it is probable that any future economic benefits associated with the item will flow to or from the entity. Second, the item has a cost or value that can be measured with reliability. Impact on net assets. Uh, Recognition affects the accounting equations. If net assets increases, the indicates the recognition of income or a gain. If net assets decreases, this indicates the recognition of an expenses or a loss. Any questions so far? If anyone is there, any question? Measuring the elements of financial statements. Measurement is the process of determining the monetary amount at which items are recognized and carried in the financial statements. Possible measurement basis: historic cost, current cost, reliable real cost value, and present value. Historic cost items are recognized at their acquisition cost. This is the most common measurement basis and is used because it is objective and verifiable. Next is the current cost items are recognized at the cost that would be incurred if they were bought today. This method reflects the current market conditions and prices. Then realizable cost value items are recorded at the amount that could be obtained if they were sold. So this amount ensures that the value of assets is not overstated. Next one is present value items are recognized at the present value of future cash flow adjusted for the item value of money. This method is often used for long-term receivables and payables. Any questions so far, if anyone's there? Okay, so understanding how to measure assets after they are initially recognized is crucial for accurate financial reporting. So here we will explore the different models and rules for asset measurements, revaluations, depreciation, and disposals. So cost model, there are two primary models for measuring assets after recognition, the cost model and the revaluation model. Cost models, under the cost model, assets are carried at their historical cost less accumulated depreciation and any accumulated implement losses. So this model ensures that the value of assets reflects their original purchase price adjusted for usage and wear over time. Depreciation is charged to allocate the cost of an assets over its useful life. This reflects the consumptions of assets' economic benefits. Impairment losses, these are recognized if the carrying amount of the assets exceeds its recoverable amount, indicating that the asset is not expected to generate future economic benefits equivalent to its recorded value. Uh, Revaluation gains and losses. So gains, these are not typically recognized or in profit or loss, but they are included in their comprehensive income and accumulated in revaluation reserve with equity. So the gain is recorded as the difference between the revalued amount and the original carrying amount. Revaluation losses are recognized immediately in profit or loss if the assets was previously measured at cost. This reflect a decrease in the assets value that impact the company's financial performance. Next is the revaluation models. The revaluation model carries assets at their fair value less any subsequent accumulated depreciation and subsequent implement losses. Fair value is generally the market value at the measurement date. So fair value, this is the price that would be received to sell an asset in an orderly transactions between market participants. Revaluations should be done regularly to ensure that the carrying amount is not materially different from the fair value at the year end. Application, if the revaluation model is chosen, it must be applied consistently to the entire class of assets. For example, our properties must be revalued if this model is applied, not just selected ones. Any questions so far, if anyone is there? Okay, depreciation and derecognition. Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. Depreciation ensures that the cost or fair value of an asset is expensed over the period that benefit from its use. Depreciation basics, depreciation charge, amount, and method. So can you see that? So depreciation charged recognize a depreciation charge for each period in profit or loss. This charge reflects the usage of the assets, economic benefits. Depreciation amount, this is the cost or fair value in the assets minus its residual value. The residual value is the estimated amount that an entity would currently obtain from the disposal of the assets after deducting the estimated cost of disposal. Next is depreciation method. The method used should reflect the pattern in which the asset's future economic benefits are expected to be consumed. No specific method is prescribed by IAS 16, but common methods include straight line, reducing balance, and units of production. Review of depreciation charge, disposal, and derecognition. So each year, and the depreciation method, residual value, and useful life of assets should be reviewed. Any necessary changes should be treated as changes in accounting estimated, like changes in methods and changes in useful life. So in method changes, if the depreciation method changes, the new method should be applied to the remaining useful life of the asset. Changes in useful life, if the useful life changes, the carrying amount of the assets should be depreciated over the revised useful life. Uh, Depreciation and derecognition, an asset should be derecognized when it is disposed of or when no future economic benefits are expected from its use or disposal. Gain or loss or disposal, calculate this as the net sales proceeds, if any, less the carrying amount of the assets. So this gain or loss should be recognized in profit or loss for the period. Requirements of IAS 7, International Accounting Standard, Section 7, asset, the statement of cash flow is crucial financial statement. The This summarize all cash movements in and into and out of a business during a specific accounting period. It provides essential information to stakeholders about the entity's ability to generate cash and cash equivalents. So cash equivalents, cash flows, includes cash on hand and demand disposal such as current accounts and petty cash as well as bank overdraft that are repayable on demand. Cash equivalents, short-term, highly liquid investments that are easily convertible to known amount of cash and carry minimal risk of value changes. Example include deposits and investments maturing within 3 months. Finally, cash flows represent the inflow and outflow of cash and cash equivalent during the reporting period. These movements are categorized into three main activities in the statement of cash flows. Any questions if anyone is there? Okay, so the principal revenue producing activities of the entity and other activities that are not investing or financial activities are direct method and indirect methods. Indirect methods most commonly used. This method reconcile profit before tax to net cash from operating activities. Adjustments include item like depreciation, finance cost, dividend received, and changes in working capital such as inventories and receivables. Direct methods alternatively allowed. This method directly lists and total actual cash flows from operating activities, including cash received from customers and payments to suppliers and employees. Any questions so far? Statement of cash flow prepared using the indirect methods typically follows a format that reconcile profit from operating to net cash from operating activities. It includes profit before tax, adjustments, cash generated by operations, interest paid, and tax paid. So direct method details the direct methods of presenting cash flows from operating activities, uh, details actual cash receipts and payments, providing a clear view of cash movements related to customers, suppliers, and employees. So the statement of cash flows concludes the series of financial statements by summarizing all cash movements within an entities over a specific accounting period. Uh, this statement provides vital insights into organizational ability to generate cash and cash equivalent overview and so these statements of cash flows typically consist of three main sections: uh, operating activities, opening activities, investing activities, and then financing activities. So operating activities covers cash flows from primary revenue generating activities and other operational transactions not classified under investing or financing activities. Investing activities includes cash flows related to the acquisition and disposal of long-term assets and investments not considered as cash equivalents. Financing activities encompasses transactions that affect the size and composition of the entity's equity and borrowing. Cash generated from operations starts with the profit before tax and adjusts for non-cash items such as depreciation, finance costs, and gains or losses on assets, disposals. Changes in working capital items like inventories and receivables are also factored in. Investing activities calculates cash flow from investing activities, including purchases and sales of property, plant, and equipment, net of depreciation and disposals. Financing activities determines cash flows from financing activities based on changes in share capital divided or dividends paid and loans. Usefulness of the statement of cash flows. There are some advantages and limitations. When we talk about advantages, liquidity insights, asset alerts stakeholders to potential liquidity issues within the organizations. Conversion of profit shows how effectively profit is converted into cash, which is crucial for assessing financial health. Objective natures, cash flows are factual and less susceptible to manipulations compared to accounting profit. Uh, Predictive capability helps predict future cash flows, adding financial planning comparability. Standardized headings facilitate easy comparison of cash flows across different entities. Here some limitations as well. Manipulations potentials. Despite its subjectivity, cash balance can be manipulated by delaying payment to suppliers or accelerating receipts. Focus on cash versus profit. Over emphasizing cash flows may lead to neglecting long-term profitability, as investment in assets may be postponed. Historical cash flow data may not reliably predict future cash flow due to changing businesses conduct conditions. Any questions so far? So interpreting the statement of cash flow, has cash increased or decreased in the period? How material is the increase, decrease in cash compared with the entity's cash balance? Does the entity have a uh, positive cash balance or overdraft? Changes in working capital, analyzing changes in inventories, receivables, and payable is essential. Increases or decreases in these items impact cash flows and reflect operational efficiency and liquidity management. Coverage of financial obligations, capital expenditures, funding, debt management. Monitoring whether debts level are increasing or decreasing helps evaluate the entities' financial leverage and ability to manage debts obligations. Long-term finance requirements. Uh, this is projecting whether the entity is likely to require additional long-term finance based on cash flow trends helps in strategic financial planning. It anticipate future funding needs for expansion or operational requirements. Any questions so far? So irrecoverable debts under the uh, prudence concept in accounting, receivable assets are only recognized if there are receivables uh, if they are expected to be recovered. When it becomes certain that a receivable will not be recovered, it must be written off and as an expense known as irrecoverable debts to the statement of profit and loss. So irrecoverable debts, these are debts that are confirmed as unrecoverable. They are written off from the receivables and expensed in the statement of profit and loss. This process reflects the uh, conservative approach to recognizing losses on bad debts. Then you can see doubtful debts. So this debit irrecoverable debts and credit sales ledger accounts. Doubtful debts when there is uncertainty about the recoverability of a receivable, an allowance known as the allowance for doubtful debt is established. This allowance offsets the receivables on the statement of financial position, reflecting a prudent estimation of potential losses. So, uh, treatment of doubtful debts or debts allows for doubtful debts adjustments, allowance for doubtful debts adjustment, debit and credit allowance for doubtful debts. Next is any questions so far? If anyone is there, accrual and prepayments. Expenses occurred but not yet paid or accrued to match them with the period in which they are incurred. So this process increases expenses in the statement of profit and loss and creates a corresponding liability increases in liability on the statement of financial positions. Prepayment of expenses. Uh, when expenses are paid in advance but relate to future periods, they are initially recorded as assets. Prepayments as time progresses that the expenses are incurred, they are recognized as expenses in the statement of profit and loss and decrease the assets in the statement of profit and loss. Or sorry, financial positions. So accruals of income earned but not yet received is accrued to match it with the period in which it is earned. This increases income in the statement of profit and loss account and creates a corresponding assets increase in assets on the statement of financial positions. Uh, Accrual and prepayments ensures that financial statements reflect transactions and even events in the correct accounting period, enhancing the accuracy and reliability of financial reporting. They adjust for timing differences between cash flows and recognition of revenues and expenses. Any questions so far, if anyone is there? So accruals and repayments are essential concept is accounting that ensures expenses and incomes are recognized in the correct accounting period, thereby accurately reflecting an entity's financial positions and performance. You can visit AT this website for uh, for cash statement of cash flows for further reading. So errors in trial balance. So there are different types of errors. Errors in the trial balance can occur due to various reasons impacting the accuracy of financial statements and requiring correction before finalizations. So type of errors, omissions when a transactions is entirely omitted from the accounting records, resulting in an imbalance in the trial balance. For example, failing to record a sales transaction can lead to an understatement of revenue. Here is a further, about uh, some more errors. Commission recording transactions under an incorrect account affect the accuracy of financial reporting. For example, categorizing repair expenses as capital expenditures can misrepresent profitability. Duplications, recording a transactions twice on one side of the account without the corresponding entry on the opposite side leads to an imbalance in the trial balance. Next is transcription error when the balance from a ledger account is incorrectly transferred to the trial balance. It results in discrepancies that need rectifications. Importance of corrections. Correcting errors in the trial balance is crucial as it ensures the accuracy of financial statements. Accruals financial reporting is essential for stakeholders to make informed decisions based on reliable information. Rectifying errors also updates the integrity of accounting practices and regulatory compliances. Uh, Errors in the trial balance are discrepancies that arise when the total of debt balance does not equal the total of credit balance. Identifying that rectifying these errors is crucial for ensuring the accuracy of financial statements. Type of errors causing trial balance differences: single entry error. These occurs when only one side of transactions is recorded in the ledger. Costing error, the type of error involves mistakes is adding up the ledger account balances. If there is an error in totaling, such as omitting or miscounting figures, it will cause the trial balance to be out of balance. Transposition error, when digits within amount are accidentally reversed during recording, it results in a transposition error. For example, recording 5,291 pound as 5,219 would lead to discrepancies in the trial balance total. Omission in the ledger balance. If a balance from a ledger account is accidentally left out of the trial balance, it will cause an imbalance between the debit and credit totals. Two entries on one sale. This occurs when there are two debit entries or two credit entries recorded without a corresponding credit or debit to balance the transactions. Any questions so far, if anyone is there? Next is error not detected by the trial balance. In accounting, the trial balance serves as fundamental tool for verifying the accuracy of ledger entries by ensuring that the total of all debit balance equals the total of any credit balances. But there are certain types of errors that may go under undetected by the trial balance, which can impact the reliability of financial statement if not identified and corrected. Uh, Error of so error of omission. Uh, an error of omission occurs when a transaction is completely left out from the accounting record. So this could involve forgetting to record a sale transactions or failing to record an expense payment. Since there is no entry made for the transaction, the trial balance will not reflect the omission balance. There are no amount in either the debit or credit column for that particular transactions. Next is error of commission happens when we incorrect amount is recorded in the accounting records. This could be due to mistake in entering figures such as recorded a purchase of £500 as £50 since the debit and credit will balance, but with incorrect amounts, these errors do not affect the trial balance ability to detect discrepancies. Single based on incorrect amount. Next is compensating errors. So compensating errors occurs when two errors cancel each other out. For example, if an expense is overstated by £100 and revenue is understated by £100, the errors offset each other. In such cases, the trial balance will still balance because the total debit and credit are equal, even though individuals accounting contains errors. Error of principles and error of principles involves recording transactions against accounting principles that are not appropriate. For example, capitalizing an expense that should have been expensed immediately or vice versa. So these errors do not impact the trial balance basic arithmetic balance between debit and credit, but can misstate financial statements by incorrectly classifying transactions. Uh, Error of original entry here. So an error of original entry occurs when a transaction is initially recorded with incorrect figures. For example, recording a sale revenue of £1,500 instead of £15,000. So such errors affect the ledger balance but may not be immediately apparent from a trial balance perspective. So because they still result in balanced debit and credit. Reversal of entries happens when debit and credit entries are mistakenly reversed during recording. Uh, for example, recording a credit transaction as debit and vice versa. This type of error also does not affect the trial balance ability to detect discrepancies as long as the amounts and accounts are correctly reversed. Any questions so far, if anyone's there? So the suspense account serves two main purposes in accounting. First one, it temporarily holds the difference identified in the trial balance until it is corrected. Then secondly, it is used when the correct account to post a transaction is uncertain or when an error needs investigations. A usage of the suspense account temporary holding when uh, an error is detected that causes the trial balance not be balanced. The difference is temporarily posted to the suspense account. This allows the financial statements to proceed with correct figures while investigation and corrections take place. Then uncertain postings in cases where the correct account for a transaction is unclear or if there is doubt about the accuracy of an entry, the suspense account provide a temporary solution until clarity is achieved. You can visit this website for further reading. For financial, you can see Tesco financial statement, Morrison financial statements. Uh, Here some references for further readings, and also there are some books available on your, you know, Moodle or learning management systems. Also, you can visit ATHE and couple on websites. Uh, Thank you very much, everyone, for joining me today. So, if any questions, concerns, or issue, you can drop me an email at yasir@ukversity.co.uk. And I hope I'll see you next Saturday, 2 o'clock for our next session. And thanks, everyone. Have a good day and bye till next Saturday. Bye, everyone.